Hey, this is Matt from InvestiQuant. Today is Wednesday, January 20th, 2021. And yesterday we started off the week with a sizable up gap. The markets were up big at the open. They sold off a bit from the open and then rallied and gave back a good portion of that rally. Ended up closing right around where they opened, forming a doji candlestick on the session. And what I want to look at today is the type of pattern that we saw yesterday at the open, combined with the indicators that we normally look at. And the indicators that we normally use are a 10 and 200 day simple moving average. And yesterday we had a pattern where we went from being below the 10-day moving average to going above the 10-day moving average, and we did that with a sizable up gap. So there's two unique patterns that really took place yesterday, and what I want to do is look at those two unique patterns and see what has happened following that the next session. So let me go ahead and set this up in Discover. We'll look at all four instruments for the pattern. It's going to be based upon entering the market long at the open of regular trading hours, which is 9:30 a.m. Eastern time, and exiting at the close. Currently, we are trading up. We have continued higher in the overnight session. So I'm going to go into the opening filters, and I'm going to select this gap direction, gap up. That just means that the open is above the prior session's closing price. So I've got that selected. Next, I'm going to go into the price patterns. I'm going to grab one of these unique patterns that we just had take place yesterday, and that pattern being, it was the largest up gap over the past 20 sessions. So that's something that can be tested within our unique moves category of the price patterns library, which is this bottom right box right here. It is the second to last option that is shown. You can still scroll down and see a few more, but it's right here. I'm going to hit equals next to that, and then I'm going to go into the indicator section and add that other unique pattern, which is based upon going from below the 10-day moving average one session to above the 10-day moving average the next session. So that can be kind of a pattern of a market that is starting to rally off the lows or something like that. We call that a moving average straddle, and yesterday would be an up straddle of the 10-day moving average because it closed below the 10-day moving average, followed by closing above the 10-day moving average. So I'm going to grab that from our moving average straddles category here. It's the top option, day after up straddle of the 10-day moving average. And then lastly, I'm going to put it above a 200-day simple moving average. And since this is an up straddle of the 10-day moving average, that by definition means that you are above a 10-day moving average now. So that covers where I would normally add above a 10 right here. I don't need to because I've got the up straddle. All right, so this is the pattern. Let me go ahead and hit view results and we'll take a look at it. All right, and here we go. These are the results of going long when you gap up following the largest up gap of the past 20 days, above a 200-day moving average, and the prior session went from the day before being below the 10-day moving average to the yesterday being above the 10-day moving average, so coming off some lows. So this pattern has happened 22 times historically in the S&P dating back to 2003, so it's not a real common pattern. The NASDAQ, 30 samples, the Dow 24 samples, and the Russell 14. So none of these have really high sample sizes. If we look at the win rates on them, 3 out of the 4 are favored. You got the S&P coming in at 64%, the NASDAQ 60%, the Dow 67%, and the Russell 43%, just a little bit weak there. But as a group, generally, these have been favored with this pattern. If we look at the average win, average loss, looks like the average win bigger than the average loss in the S&P. That's also true for the NASDAQ. That is true for the Dow and true for the Russell. So all 4 of these have had larger average wins compared to their average losses, and the win rates on 3 out of 4 of them are favored. So it's really just the Russell that does not have a favorable win rate. Again, it is a rare pattern, so keep that in mind. This isn't, we're not looking at something that has 100 samples in each of the instruments. They are lighter on sample sizes, but if you combine them all together, they are mostly in agreement that it has favored the upside the following session historically. So I thought it was a unique pattern, figured I would share it with you guys today. Good luck, and we will see you next time.